Hi, my name is Andrew, and I'm an R&D tax consultant at Fullstack Advisory. This is a presentation on early stage innovation companies and the benefits and requirements of being an ESIC. So to start off, the main benefits of being an ESIC really accrue to the investors. As a company, the benefit of being an ESIC is that you are a more attractive investment for your investors. And that's because the benefits the investors receive are a 20% non-refundable tax offset on their investments in ESICs, and that's capped at $200,000 for people qualifying as sophisticated investors. And the second benefit that they receive is there's no CGT payable on ESIC shares held for a period of 12 months up to 10 years. And after that 10 years, the cost base of the share is the market value at the 10-year mark. So a disposal of a share at 7 years will attract no CGT, and the disposal of a share at the 11-year mark would attract CGT only on the appreciation between that 10-year and 11-year mark. And so, as I mentioned, there are different types of investors. The scheme gives preferential treatment to people qualifying as sophisticated investors. So to qualify as a sophisticated investor, you have to meet asset and income criteria. That income criteria is at least $250,000 of income in the last 2 financial years. Or alternatively, you can have net assets of $2.5 million. And you'll need a certificate from a qualified accountant issued within 6 months of making your investment, stating that you meet those income or asset criteria. In addition to those criteria, you also have to have one of the following with respect to the investment itself. So you have to have invested at least $500,000 in the shares, or you could have received the offer through a financial services licensee and acknowledge that there's no disclosure document provided with that offer. Alternatively, you could qualify as a professional investor under the Corporations Act, or you can possess or control gross assets of at least $10 million, and that includes assets under management. And so the preferential treatment that the ESIC program gives to sophisticated investors is that you have no limit on your investment, but your tax offset is capped at that $200,000 annually. And so it's a 20% tax offset. So that's the first $1 million invested in ESICs would be eligible for that tax offset up to $200,000. Anything in excess of that won't be eligible for the tax offset in the given financial year. If you don't qualify as an ESIC, either you don't meet those income and asset criteria, or you don't meet the investment criteria, then your ESIC investment is limited to $50,000 in a given financial year. If you invest more than that, you're disqualified from claiming the tax benefits. So you won't be able to claim the tax offset for the $50,000 you invested or the CGT exemption for the investment in those shares. And so that covers really the benefits for the investors. So I'll move on to speaking about what's required for companies to qualify as an ESIC, and it's in the name. So there's an early stage component and an innovation component. The early stage component is relatively straightforward. You just need total expenses under $1 million in your previous income year and assessable income under $200,000. There's also a prohibition on having shares listed on a stock exchange. So it's straightforward. As long as you meet those criteria, you're an early stage company. For the innovation component, you can qualify for the innovation component under the 100 points test or the principles-based test. 100 points based test is on screen there, and you can see the different things that you get points for. So that includes having notional deductions under the R&D tax incentive, if you've received an accelerating commercialization grant, or if you're in an incubator or accelerated program, or you're filing patents and creating intellectual property. So you can qualify under the 100 points test. Once you reach 100 points, you're eligible as an ESIC. The alternative to that is the principles-based test. So if you can't qualify under the 100 points test, you may still qualify under the principles-based test. There's a little bit more judgment inherent in the principles-based test, and because of that, you can apply for a private ruling from the ATO. The private ruling isn't available for 100 points, but it is available only for the principles-based test. And there are 5 requirements, but as an overview of what's required to meet the principles test, you have to be a company focused on innovation for the purpose of commercialization. You have to substantiate that your innovation will give you a competitive advantage over other competitors in the market. And then you have to also demonstrate that as a business, you have the ability to scale up and meet the global demand for your innovation. So if you're an ESIC and you have investors wanting to make an investment, you'll be asking when you're actually required to submit an application, lodge a report. So you're required to lodge a report in any year where you issue new shares and the issue of those shares might result in the investor wanting to claim the tax benefits for those shares. So that can be either the tax offset or the exemption from CGT. So if that happens in a financial year, you're required to submit a ESIC report for that financial year. You have to submit it within 1 month of the financial year ending. So for most businesses, that's going to be 31st of July. The ESIC report will declare your status as an ESIC, and it will also declare how you met the criteria under the 100 points test or the principles-based test. So you'll declare which one you met, and then you'll also detail the investment specifics. So the name of the person making the investment, how many shares that they acquired, and the purchase price that they acquired them for. So there are some things to look out for because there are exclusions around qualifying investments. The main one to look out for here would be if you and the ESIC are affiliates. So the Australian Tax Office has a definition of affiliates. That's where one entity could be expected to act in accordance with another entity's wishes. That can arise due to personal relationships or business relationships. But if you are an affiliate of an ESIC or the person making the investment is an affiliate of an ESIC, then that investment in the ESIC won't be eligible for the tax benefits. In addition to that, another one to look out for is that the shares were acquired through an employee share scheme. So the acquisition of those shares also won't be eligible for tax discounts or CGT exemptions. And so because this is a full stack presentation, I would like to cover how we can help you. So first and foremost, we can help you determine whether or not you actually need to submit a report to the ATO for your ESIC status in a given financial year. If you do, we can always help you prepare and submit your ESIC reports. As mentioned, if you'd like a bit more certainty or your investors would like a bit more certainty that you qualify as an ESIC and you want to apply for that private ruling under a principles-based test, we can prepare and submit that application for you. And one of the main ways we help businesses qualify as ESICs is by helping them prepare and submit their R&D tax applications. So they're up to 75 points under the 100 points based test if you have no short deductions under the R&D tax incentive, and we can help you prepare and submit those applications. If you have any questions about ESICs or anything covered in this presentation, feel free to reach out to me. I hope this was a good starting point, and thank you for listening.